Hi everyone, my name is Carlo Chakwas Victor. I welcome you all to section 4 of our free Excel classics. So in this section 4, we'll be talking about the financial application and reporting. Here we'll be talking about how to apply Excel to weigh financial decisions and create simple reports. So we'll be looking at the simple interest, the compound interest, present value, and future value. Then we'll go and look at the investment appraisal where we'll talk about the NPV, that's net present value, the IRR, the internal rate of return, and the payback period. Then we'll look at the basic data visualization. So today, without wasting much time, we'll quickly start with the simple interest, which I wrote XI here. So we'll start with the basic from the beginning. So assuming that we have this data here, 10%, 100,000 as the principal, and 3 years, and we're asked to calculate the simple interest, we simply come here and type equals to, then you pick the principal, which is 100,000. By selecting it here, it will come out here as usual. Then you multiply it by the rate. So you say multiplied by the rate, which is 10%. It's already on percentage, so you just multiply it. Then you multiply it by the time too, which is the 3. So it remains the principal times 3 times time. So you multiply everything. After you have finished multiplying it, you hit enter. So it tells you that the simple interest is 30,000. So that is how to do simple interest using Excel. So let's go to the next one, which is the compound interest. I noted it with CI. As you know, the compound interest is one of the major breakthrough in finance. In fact, it is one of the wonders of finance. So it is interest that you earn on your interest. It keeps compounding. It keeps compounding. So right now, given this data also, we will do the compound interest and see the difference. So as you can see, this particular one in 3 years time will give, if it is simple interest, it will be 30,000. Using the same data, let's do for the compound interest and see the interest we will earn at the end of 3 years. So we simply come here, we type equals to, then we select the principal, which is the amount, then we multiply. After we have clicked multiply, we open our parentheses, which is a comma, then we say 1 plus the rate. The rate is 10%, so we click on the rate and close our parentheses. After we have done this, we raise it to power 3 because it is raised to power 3 because 3 is in years. So we say raised to power 3. So you clicked the 3. So you see how our formula looks like. After you have done this, you need to remove the principal, that is the amount, to get only the compound interest. So you now say minus the amount again because you want to see only the compound interest. Then you hit enter. So if you hit enter, it automatically tells you that it is 33,100. So have you seen the difference between this one? This one was doing only 10% for each year, 10% each year, 10% each year. That is 10,000. Then into 3 years is 30,000. But this one we keep compounding it. So the simple interest is quite different from the compound interest because the compound interest will keep compounding your interests. So this is how to do simple interest and compound interest. So going forward, let's talk about the present value and the future value. So permit me to wipe off this place so that we will not get distracted. So right now we want to do the present value and the future value. So we'll take it one by one. We'll first of all do the present value. Before I hit the present value, let me define the present value for non-finance professionals that might be here. So the present value is the current value of a future amount. That is the money you will receive today in the future when it is discounted. So it helps you to know the present value of the money you will receive in the future. Imagine someone is telling you that they will give you 20,000 in the next 10 years, in the next 5 years, and you want to know what is the value of that 20,000 today. So you will bring that value, that money today. So instead of waiting for the next 20 years to know the value, you can know the value today. So assuming in this particular question, let's change this here to 5. So now, in this particular question, you are using 10% as the rate, then the amount is 100,000. So this amount here is the future amount, that is the future amount, the future value, that is the amount they will pay you in the future. The amount they will pay you in the future. So you are to receive 100,000 in the next 5 years. But you want to know the present value. This 100,000 in these 5 years, I want to bring this 100,000 back to this year to know how much it is currently. Okay, so you now say equals to, you now use the present value formula by typing PV. So once you type PV, the present value comes out, you select it. After you have finished selecting it, you select the rate. The rate is 10%, you clicked on it, then you put comma, then the years is 5 years, you select the 5 years, then you put comma. Because this is a one-time payment, you are receiving the money at the end of the 5 years, so, and it is not periodic, so you just say the payment is 0. After that, you will type 0 manually, then you put comma. Then at this point, this amount, this future amount is in negative, so you say minus, then you pick the figure because this amount is supposed to be in negative. It is a future amount. And after that, you close your parentheses and you hit enter. So it tells you that it is 62,092,000. So it means that today this 100,000 is worth 62,000. So are you to wait for 5 years to receive 100,000, or you will pick the present value today? They should give you 62,000 today. So it means that 62,000 today, in the next 5 years, it will be 100,000. That is what the present value is trying to tell you. You are bringing back the money. So the present value is always lower. That is how you will know. So let's go to the future value and understand the future value as well. So the future value is the opposite of this present value that we just did. So the future value of the amount you are having today. Let's say you have 100,000 today. So what will the 100,000 be in the future? What will the 100,000 be in the next 5 years? Let's still use this same data here and know what this 100,000 will be in the next 5 years. In the present value, we brought down this 100,000 today. So this time around, this 100,000 is today. We want to know what it will be in the next 5 years. So we simply come here, we type the equals to, then we click FV. The future value comes out. We double click and select it. After we have selected it, we pick the rate as usual, which is 10%. Then we put comma. After that, we pick the years, which is 5 years. We put comma. Then we put 0 by typing 0 manually because it is not a periodic payment. Then remember that your value should be in negative. So after that, you put it in negative, then you select the value and you close your formula. After you have closed the bracket, you hit enter. So it tells you that it is what? It is 161,051. So it is 161,000. So in the next 5 years, if you invest this 10,000, in the next 5 years, you will make 161,000. So the future of 100,000 is 161,000. So you see the difference between the present value and the future value. So this is how to do the present value and the future value in Excel. So we enter the next part, which is the investment appraiser. So under this investment appraiser, we'll look at the net present value, which is denoted by NPV. So the net present value helps you to evaluate a project, to know the particular project that that will be viable or is viable, so that you will know which one to select. If a project gives you a positive outcome, you accept. If it is a negative outcome, you reject. And if it is 0, you either reject or you accept. So right now, we use this information here to solve for the NPV. So to solve for the NPV, it is very, very simple. You simply come here, you type equals to, then you type the NPV. Once you type the NPV function comes out, you double click on it to select it, then you start with the rate as usual. You pick the rate, you put comma, after then you pick all the inflows from here to here. So after you have picked all the inflows, you close your bracket. So let's assume that the outflow is 100,000. We did not type the outflow. So let's assume that the outflow is 100,000. we'll make the outflow 100,000 so that we'll be able to find the NPV. So let's redo the NPV now again. We say equals to NPV, we select the NPV. After selecting the NPV, we select the rate, we put comma, then we select all the inflow first. After selecting all the inflow, we close the parentheses and then we add this outflow. So we say plus the 100,000. So this 100,000 is also in negative because it's outflow. So you first of all put comma before you add it, then you hit enter. So it tells you that the NPV is 22,000. For the IRR, so we'll continue with the IRR. We say that the IRR is the internal rate of return. It is the discount rate that makes your net present value to be equals to 0. That is the annual return of your investment. So given this particular information, the company is telling you that their rate of return is 15%. This means that anything below 15%, they will not accept the project. They will only accept a project that has more than 15%. So given this information, you want to find the IRR to see whether this project is viable or not, whether it will return a good rate. So you simply say equals to, then you type your IRR. The IRR comes up, you double click on it, then you select everything, both the outflow and the inflow. You select all of them. After selecting all of them, you close your parentheses and you hit enter. It tells you that the IRR is 22%. So you will now compare this 22% and the one the company sets, which one is above. So since our own is bigger, you advise them to accept the project since the IRR is bigger and thus it is viable. So the last thing we'll do is the payback period. The payback period is the time it takes to recover your initial investment from your cash inflows. That is, if you invested 100,000 in a business and the business from year 1, year 2 and year 3 made this amount, what would be your payback period? That is, at each year will you say that yes, you have recovered your money and you are now enjoying the dividend of your investment. So you simply come here. Since the payback period doesn't have any function in Excel, you have to figure it out manually. So let's say that here is the year, then here is our cash flow. So we type these ones. Here is our cash flow, while here we type here as our cumulative cash flow. So cumulative cash flow, I will shorten it so that we will save time. So cumulative cash flow. Then after we have done this, let's shift a little bit so that it will make more sense. Then we now copy our cash outflows and all the inflows. We copy all of them. After copying all of them, we copy all of them. Then we copy all of them and paste it here as our cash flows. So you can decide to number this from year 0 is your choice, 1, 2 and 3. Then after that, you start doing your cumulative cash flow. So you still bring this one, you copy this one and bring it back here. Then after you have done that, you now say this minus this, it will give you this. So you simply put the formula, you say equals to, you pick this one, then you add it to this. If you add two of them, it will give you this. So you say plus this, what will it give you? You hit your enter. So you don't need to continue to put it in all these ones. You just need to drag this one down. Once you drag it down, you get your final result. So as you can see, here is where the negative stops. So you want to find your payback period. So your payback period will now be, you now type equals to, since you know it stopped at 2 years, so you start 2 years plus, then you now divide this 10 divided by 60,000. So you either type it or you divide it manually. So whichever way, you can simply say 10, 1, 2, 3 divided by this 60,000, or you click on it. So whichever way you want, after doing that, you hit your enter. It will give you 2.1. So it means that in 2 years and 1 month and some few days, you'll be able to recover the money you invested in the business. That is, in 2 years and few months, you will recover your 100,000 back and start making profit. So this is how the payback period works. So I hope you learned something from this investment appraiser. Thank you very much, and I hope to see you in my next video. Bye for now.